Hello dear learners, welcome to the third video of. In this video, we will discuss non-institutional sources of agricultural finance. Agriculture is the backbone of Indian economy, employing a huge section of the population. However, farming is highly dependent on credit due to seasonal income, that is, earnings come after harvest, but expenses occurred throughout the year. High cost of inputs, uncertain weather, that is droughts, floods and pests can ruin the crops. Family and social obligations, that is the functions of the farmer's household, marriage, medical emergencies, educational expenses of the children. And to meet financial needs, farmers seek loans from two types of sources, that is institutional credit provided by banks, cooperatives and government schemes. This includes commercial banks, regional rural banks, cooperative banks, NABARD and microfinance institutions. The government has launched several schemes such as Kisan Credit Card, PM Kisan Samman Nidhi and interest subvention schemes to promote affordable rural credit. Non-institutional credit provided by moneylenders, landlords, traders and relatives. These sources dominate rural credit mainly due to easy accessibility, lack of banking infrastructure and farmers' urgent needs. Despite the government's effort to expand institutional lending, non-institutional sources still account for nearly 30 to 40% of agricultural credit in many rural areas, mainly due to easy accessibility, lack of banking infrastructure, and the urgency of farmers' need. Now, what are the sources of non-institutional credit? Non-institutional credit sources can be categorized into several types, each playing a significant role in rural financing. The most common source is moneylenders, who are easily accessible and provide instant loans without requiring any collateral. However, they charge extremely high interest rate, sometimes ranging from 48% to 120% per year. For example, a farmer took a loan of Rs 50,000 from a moneylender at an annual interest rate of 50%. Due to a poor harvest, he was unable to repay the loan on time. The moneylenders then added hidden charges and additional interest, forcing the farmers to take another loan just to pay off the first loan. This led to debt trap that become nearly impossible to escape for the farmers. Another common source of non-institutional credit is borrowings from relatives and friends. These loans are usually interest-free or have minimum interest and are useful for small emergency expenses like medical bill or daily needs. However, they are not sufficient for large agricultural investment. For instance, a farmer might borrow Rs 5,000 from his uncle to repay an irrigation pump, to repair an irrigation pump. But for bigger loans like purchasing of a tractor, family members may not have enough financial resources to help. Traders and commission agents play a significant role in rural credit. They provide farmers with credit for purchasing seeds, fertilizers, and equipment in exchange for the commitment to sell their produce at a lower price after harvest. This dependency reduces the farmer's bargaining power and forces him to sell at disadvantage. For example, a farmer may take a loan from an traders and commission agents for purchasing seeds. At the time of harvest, the agent compels him to sell his produce at 20% below the market price, ensuring the agent's profit while reducing the farmer's earnings. In certain feudal areas, landlords continue to provide loans to small farmers in exchange for labor or a portion of the harvested crop. This practice often leads to exploitative relationship where farmers are trapped in long-term dependency on landlords. For example, a small farmer who borrows money from his landlord to buy fertilizers may find himself forced into bonded labor as he struggles to repay the debt. Since the landlord keeps adding new charges, the repayment never ends, perpetuating the cycle of exploitation. Then input suppliers, including seeds and fertilizer dealers, also provide credit to farmers by allowing them to purchase agricultural inputs on credit. The repayment is usually expected after the harvest. However, these suppliers often inflate prices, making the credit costlier than traditional bank loans. For example, a farmer buys pesticides and fertilizers on credit from a local trader. At harvest time, he discovers that the dealers has inflated the prices by 15 to 20%, forcing him to pay a much higher amount than he initially expected. Now, despite having all these disadvantages of the non-institutional sources of finance, why do non-institutional sources still dominate? The first reason is immediate availability of loan. Unlike banks, which require extensive documentation and long processing time, moneylenders provide instant cash without formalities. This is crucial for farmers who need funds before the sowing season or during emergencies. For example, a farmer in Assam needs Rs 50,000 to buy seeds before the monsoon. The bank will charge 8% interest per year, but then the bank requires collateral and credit history, delaying the process by 2 weeks or 3 weeks. Desperate, the farmer borrows from a moneylender who provides the amount immediately but at a higher interest rate of 50% to 120% per year. Number 2, lack of banking penetration in villages. Many rural areas still lack bank branches or have limited access to banking services. Farmers must travel long distance to access a bank, which is costly and time consuming. For example, in a remote village of Rajasthan, which is located near Pakistan border, the nearest bank is about 25-35 kilometers away. A farmer needs 10,000 for fertilizers, but finds it impractical to travel frequently. Instead, he borrows from the local traders, who charges an inflated price for fertilizers and additional interest on the loan. The next is low literacy rate. Many farmers cannot read or understand banking procedures. Complex paperwork and digital banking system discourage farmers from seeking bank loan. For example, a farmer in Chhattisgarh visited a bank or for a loan of Rs 30,000. He struggles with loan application, interest rate calculation, and banking terms. Instead of seeking help, he approaches a moneylender who provides an informal verbal agreement and releases the money immediately, charging an interest of Rs 40% annually. The next is seasonal urgency. Agricultural activities are time sensitive, requiring funds before sowing and harvesting. Banks often take weeks or months to process a loan, leading farmers to choose faster non-institutional loans. For example, a sugarcane farmer needs money just before the sowing session. The bank asks for land records and income proof, which delay the process by 3-4 weeks. Instead of doing that, the farmer takes an immediate loan from a trader or a moneylender or the landlord, who later forces him to sell his produce at lower price as repayment. The next reason why still the non-institutional sources of credit dominate is flexible repayment terms. Unlike banks that requires fixed monthly installments, moneylenders allow repayments in crops, services, or flexible schedules. This appeals to farmers who have fluctuating income and cannot adhere to a rigid payment schedule. For example, a cotton farmer borrows from a local landlord. Instead of paying back in cash, he agrees to work on the landlord's field for 6 months. While this seems flexible, the farmers end up working for an unfairly low wages, effectively losing more than the original loan amount. Despite surging high rate of interest and many exploitation, why do Indian farmers still depend on non-institutional credit? The reasons are poor banking infrastructures in rural area. In many Indian villages, farmers struggle to access formal banking services due to poor banking infrastructure. Still, there are many villages which are not covered by the government banking services or the formal financial services. With limited bank branches in rural areas, farmers are often forced to travel long distance just to access financial services. Even when they reach a bank, the process of loan approval is time consuming. It takes weeks, months to get a loan sanctioned. In contrast, local moneylenders provide instant cash without any formalities, making them the preferred choice despite high interest rate and exploitation. Banks often prioritize large loans, leaving small farmers struggling to get the credit they desperately need. This forces many farmers into a cycle of dependency on moneylenders, trapping them to long-term debt. The next is complex loan procedure and documentation. Bank requires land record, Aadhaar card number, income proof, and collateral, which many farmers do not have. Illiterate farmers struggle with complex paperwork and prefer verbal agreement with the non-institutional lenders like moneylenders, landlords, etc. Then the urgency of money. Farming is a seasonal and time-sensitive activity. Credit is needed urgently just before the sowing and harvesting. Bank takes time, but moneylenders provide immediate cash. And that is why farmers prefer to go to the moneylenders instead of going to the banks. Then the traditional dependence on moneylenders. Illiteracy and lack of financial awareness keep farmers dependent on non-institutional sources. Farmers trust local lenders and traders over banks. For example, traders give farmers fertilizers on credit, but they must sell crops back to the trader at unfairly low prices, reducing their profit. Now, in order to reduce the dependency of Indian farmers on non-institutional source of credit, government has initiated many reforms to reduce the percentage of non-institutional credit. One of the most significant steps taken by the government to reduce farmers' dependency on non-institutional credit is the expansion of institutional credit through banks and cooperatives. The nationalization of banks in the year 1969 played a crucial role in expanding credit availability to rural areas, ensuring that financial services reached small and marginal farmers. This was further strengthened by the lead bank scheme, which assigned specific banks to districts to oversee rural credit expansion and financial inclusion. Another most significant steps taken by the government to reduce farmers' dependency on non-institutional credit is the expansion of institutional credit through banks and cooperatives. Under the priority sector lending, mandate. Commercial banks are required to allocate at least 18% of their total bank loans to the agriculture sector. This ensures that a significant portion of credit is directed towards farmers, helping them accessing funds at lower interest rate compared to moneylenders. Additionally, regional rural banks and cooperative banks play a crucial role in providing affordable credit to farmers, especially in remote areas where commercial banks have limited reach. These institutions offer low-interest loan to small and marginal farmers, ensuring financial inclusion. Other significant government initiative includes the Kisan Credit Card Scheme, which provides farmers with easy and flexible access to credit, PM Kisan Samman Nidhi, a direct income support scheme that helps farmers meet financial obligations without resorting to exploitative lenders. The interest subvention schemes also provides subsidized credit to farmers, ensuring they can access loans at lower interest rate. By strengthening these rural banking networks and launching targeted financial support programs, the government aims to reduce farmers' dependency on exploitative non-institutional credit sources and promote sustainable agricultural growth. Now, if we discuss the demerits of non-institutional credit, though it can be observed from our discussion, but if we want to point it out, then what are the demerits of non-institutional credit? Number one is exorbitant rate of interest is charged by moneylenders and other non-institutional sources, making it impossible for the farmers to redeem the loan. Again, indebtedness is the main problem arising out of rural credit. The burden goes on accumulating, and in certain cases it leads to perpetual burden. Then loss of land and property. Failure to pay the loan and interest results in loss of land and property to the lenders of credit. Small and marginal farmers are deprived of ownership of their lands when they cannot repay the credit. Malpractices are indulged in the form of obtaining thumb impression or signature on or blank bond or stamp papers, misusing them and thus depriving the farmers of their property and assets. Exploitation of farmers become easier by making them obligated to render free services to moneylenders and landlords. Traders compel them to sell their product at lower prices immediately after the harvest. Again, bonded labor is the result of indebtedness of small and marginal farmers. In certain cases, it may even continue from generation to generation as they cannot redeem the debt due to high interest and other malpractices resorted by the lenders. In conclusion, we can say that despite government efforts to expand formal credit, many farmers still rely on non-institutional sources due to accessibility, urgency, and lack of awareness. Strengthening rural banks, educating farmers, and enforcing regulations on moneylenders can reduce exploitative lending practices and improving farmers' economic well-being. So this was all about non-institutional sources of agricultural finance in India. In this video, we had discussed various sources of non-institutional agricultural finance, causes of its dominance, and demerits of non-institutional credit. Thank you for watching this video. Thank you.